Hi guys, hope you had a great Holi. I sure did. Markets are at all-time high. You're all happy about it, but when you look at the funds in your portfolio, you're like, why is it that the funds are underperforming? The active versus passive style of investing and fund management debate has been there for some time now, and a lot of people think it is because of higher fees and manager skills and so on and so forth that the active funds are underperforming. So instead of speculating, we thought, why don't we do a fact-based assessment of fund manager skill? After all, you can't manage what you can't measure, right? So in this video, I try and analyze how a fund manager generates alpha, and in the second half, I tell you why is he not able to do it. Manager's conviction is the key focus to analyze any portfolio. You can measure how committed is a manager to the portfolio by his underweight and overweight positions. When you analyze the portfolio in detail, you can figure out that the reason for stock selection alpha is not his underweight or neutral positions, but high conviction overweight position on his best ideas. To put it very simply, if the fund manager starts concentrating on what to buy in whole lots than what not to buy, he will end up having stock selection alpha. This theory in itself defies the long held assumption that the managers can generate alpha by following a different stock selection and investment selection process. Now you may be thinking, if it is so simple, why don't fund managers do it? I had the same question. Why do they actually do a lot of market hugging or beta anchoring, which is nothing but creating portfolios as close to the benchmarks as possible? Believe me, no fund managers want to outperform the benchmark. Everyone wants to create alpha. They try and do it by going 50 to 55% overweight on a lot of high conviction bets. They definitely do it. That's not the problem. The problem is the other part of the portfolio where they are underweight or neutral on the markets. This is like, you create an alpha via overweight position, but the underweight and neutral positions negates that alpha, and this is why you have zero or negative alpha. Let me give you an example of cricket. You play an all-rounder so that he performs well in both the innings, but with this kind of a strategy, you stop him from playing in the second innings. How will he create a winning formula? How will you win? A lot of industry folks will come and say beta hugging is a great strategy. Of course, that helps you to have reduced tracking error, thereby you're less answerable to the stakeholders. But remember, the investor is not paying you such huge fees so that you can go and hug the index. He is paying you a fee to perform and create alpha, right? You may say risk management. Of course, risk management is important, but the cost of risk management should not be so high that you pay it with performance penalty. That's the whole reason why in the last 5-7 years, there are only 3 or 4 funds, especially in the large cap space, that have beaten the index. The industry is now smartly blaming it on higher fees. Of course, fees matters, but that is secondary. If you can create significant alpha, this will have a major structural impact than the fees itself. So choose your fund manager smartly. The good news is there are plenty available, but the bad news is they are failing before they can deliver. So make sure you choose the right one. Hope you like this video. Thank you.